Welcome to another insightful episode of Financial Insights in Minutes. We provide time-saving summaries of the day's top financial news to keep you informed. Today, we will delve into pivotal discussions including China's economic challenges and capital flight, the anticipated impact of CPI data on the market,
and insights into recession risks as we approach 2024.
Stay tuned and make sure to catch our expert analysis and key takeaways. First, Eurodollar University delves into the alarming trend of capital flight from China and its global ramifications. Next, Trade Brigade analyzes live CPI inflation data and explores its potential market effects following today's release. Game of Trades warns of a looming financial system collapse inspired by the recent surge in the Japanese yen. David Lin hosts economist Thomas Hoenig to discuss whether the Fed should implement emergency rate cuts amid rising bankruptcies. Figuring Out Money examines the stock market's bullish signs despite underlying concerns about new CPI data. Kitco News highlights Tesla's breakout potential and the strength of gold ETFs amid current market volatility. EPB Research debates the likelihood of a recession in 2024 with economic experts Brian McCarthy and Dayan. Lastly, David Lin invites Stephen Moore to discuss GOP economic policies and their implications on inflation. Welcome to Eurodollar University. Today, we're diving deep into a hot topic. A record amount of capital is urgently fleeing China. We're joined by our expert Jeff Snyder, a seasoned economist with a knack for breaking down complex monetary systems.
That's right. Jeff's expertise in global finance will shed light on why this mass exodus is happening and what it means for the global economy. Buckle up for an informative ride.
So what's the core message from Jeff's latest video?
The thesis centers on the unprecedented capital flight from China, attributed to both a significant drop in foreign direct investment and tightening lending conditions by Chinese banks.
Let's break this down. What are the standout points?
Firstly, foreigners pulled out a staggering $15 billion in the second quarter. To add salt to the wound, Chinese banks recorded their first contraction in lending to the real economy in 19 years.
And what about foreign direct investment?
Foreign direct investment took a hit with a negative $15 billion. This is only the second time we've seen a decline since records began. Yikes!
What's the scoop on the internal economic conditions?
Chinese banks are contracting real economy loans with a drop of $10.7 billion in yuan-denominated loans. Overall financing dropped to 770 billion yuan. That's less than last year.
Looking ahead, what should we brace ourselves for?
Predictably, we can expect continued capital flight as investors grow increasingly wary of China's economic stability.
And what about governmental responses?
We might witness more authoritarian measures. The government is likely to impose stricter regulations to control the outflow of capital and stabilize the chaotic markets.
Wrapping up, what are the big takeaways?
China's economic landscape is facing serious threats with rapid capital outflow and tightening lending conditions. The future remains uncertain, so investors should keep a close watch on further developments.
Any final thoughts on what we need from China's authorities?
Transparency and trust in policymaking will be crucial if China wants to regain investor confidence. Right now, it looks more like a turbulent sea ahead.
Welcome to Trade Brigade's live pre-market prep show. Today's mission, analyzing the Consumer Price Index inflation data and its potential market implications. Get ready, because Matt will guide us through the tumultuous seas of today's financial landscape.
That's right. This CPI release is crucial for the market sentiment. Inflation concerns are on everyone's mind, and Matt's insights will help us navigate this tricky environment.
So, what's the primary thesis here? What's driving the analysis?
The core thesis is centered on the upcoming CPI data acting as a crucial indicator for inflation and market direction. If inflation shows signs of cooling, it could set the stage for potential Fed rate cuts, impacting financial markets significantly.
What key points stand out regarding the CPI's potential impact?
First off, watch how the market reacts to the CPI figures. If they align with predictions, we might see positive momentum. If not, brace for turbulence. It's all about smoothing out those expectations with the Fed's approach.
How are the markets bracing for this data?
The markets are notorious for their short attention spans. We're seeing major levels in the S&P 500 maintaining a fragile balance. The results from today's CPI report could lead to significant market adjustments either up or down.
What about the specifics of the inflation analysis?
Service inflation remains an important focus since that's where the sticky elements are located. Fluctuations in energy prices could also influence the broader inflation outlook.
What predictions are being made based on the CPI expectations?
If CPI comes in as predicted, we could see the market stabilize further. But any unexpected spikes could spell trouble, driving bearish sentiment into the market.
What about long-term market trends?
Definitely keep an eye on employment metrics post-report as they'll play a larger role. Traders need to stay flexible and ready to adapt their strategies based on market movements after the inflation data.
Wrapping it up, what are the main takeaways for today?
Today's CPI report is crucial. It could drastically shift market sentiment. Investors should prepare for potential volatility and ensure their trading strategies remain adaptable. Let's keep tickets ready for a roller coaster today.
Welcome to another dive into the finance seas. Today, we're navigating through some turbulent waters, discussing the recent surges in the Japanese yen and its implications for the global economy. Buckle up, folks.
That's right. This discussion pulls from some rich historical data, echoing trends of the past. It's all about understanding how these shifts in the yen could signal broader economic changes.
So what's the main takeaway from this analysis? What's the deal with the yen?
The core thesis is that the recent strengthening of the Japanese yen points to an unwinding of leverage in the financial system, potentially foreshadowing an economic downturn akin to previous crises.
Let's break down those key points. Firstly, what's all the fuss about the yen?
The yen surged by a record 10% over 5 weeks, an event only mirrored twice in the last 30 years. This drastic shift usually accompanies market turbulence. History really loves to repeat itself.
Interesting. And what's the historical backdrop here?
Precise. We've seen similar movements in 1998 and 2008. Each time, as the U.S. unemployment rate increased, there was a significant uptick in the yen's value. It's like watching economic dominoes fall.
Could you explain how carry trades fit into all of this?
Absolutely. Investors often borrow yen at low rates to invest in higher yield assets, creating leverage. However, as the yen strengthens, this leverage can exacerbate market declines, launching us further into turbulence.
Let's talk predictions. What's in the crystal ball?
Should the U.S. economy weaken, the yen's strength could persist, triggering more deleveraging across the system, echoing past market collapses. We could be in for some rocky waves ahead.
And what happens if those recession fears fade?
If recessionary concerns begin to ease, we could see leverage rebuilding akin to 1998, where temporary downturns didn't lead to recession. It's a wild economic cycle.
To wrap it up, what's the big picture?
The key takeaway is understanding the interconnectedness of these financial trends. As economic indicators shift, so do implications for the markets. Staying alert is essential for navigating these stormy financial seas.
What final advice do you have for our viewers?
Investors need to stay aware of the risks flowing from leverage and its ties to fluctuations in the yen, particularly during times of rising economic uncertainty. Better safe than sorry.
Welcome back to the channel. Today, we're diving into some urgent financial discussions with the insightful Thomas Hoenig, who has an extensive background in the Federal Reserve. Buckle up.
Absolutely. With 4 decades of experience as an economist, Hoenig is here to shed light on whether the Federal Reserve should cut interest rates in these turbulent times.
Let's break down Hoenig's core thesis. What's the big picture here?
Hoenig argues that cutting rates prematurely could exacerbate inflation risks. High inflation creates uncertainty and impacts employment stability, complicating the Fed's decision-making process.
What about the recent market volatility? Tell us more.
Hoenig emphasizes that recent volatility is a reaction to past Fed actions and doesn't denote an immediate need for intervention. It's crucial for the market to absorb risks independently.
And how does inflation fit into the employment picture?
Inflation can undermine stable employment. Hoenig stresses the need to control inflation first. Once it's under control, employment can stabilize.
What about the banking sector's vulnerabilities?
Hoenig indicates that if banks lack adequate capital, they'll struggle during market downswings. Rising interest rates lead to more bankruptcies, especially among zombie companies.
What are Hoenig's predictions moving forward?
He suggests that any talk of rate cuts should only happen once inflation reliably moves towards the 2% target. Until then, expect ongoing volatility.
Any trends indicating a downturn?
Higher bankruptcy rates signal stress in the economy. Hoenig notes that managing these changes effectively is crucial for staying afloat.
To wrap things up, what should we take away from Hoenig's insights?
Hoenig calls for a strategy to balance inflation control with economic stability. Understanding the risks of premature rate cuts is key to navigating these turbulent waters.
And what about interventions from the Fed?
He strongly believes that the Fed should refrain from intervening at every turn, as it could lead to moral hazard and poor market behavior.
Welcome back, everyone. Today, we're navigating the turbulent waters of the stock market with a fresh follow-through day.
Absolutely. Michael discusses pivotal shifts in market trends and the implications of upcoming CPI data. Let's set sail.
So what's the main message from Michael's insights?
The key thesis is that the stock market has confirmed a follow-through day, which could signal upcoming bullish trends despite underlying concerns.
What should we understand about this follow-through day?
To qualify, the market must rise at least 1.2% with higher volume than the previous day. It just checked both boxes.
What's on the horizon with the CPI data?
The CPI report is poised to induce significant market swings with an expected movement around $530.
What's the current state of the market?
The market is unusually tight without shakeouts, defying typical patterns during Fed tightening. It's progressing upward without the typical downturn.
What levels should viewers keep an eye on?
Monitoring previous lows is critical. If the market dips below these levels, caution is necessary.
What are the potential outcomes with the CPI report?
Brace for impact. Following the CPI, we could see dramatic price reactions. Upward bounces or sharp declines are both on the table.
Any thoughts on market resilience moving forward?
If the follow-through day sustains, we might witness bullish trends. However, it's prudent to stay alert for any signals of reversal.
To wrap it up, what are the main takeaways?
Maintaining a cautious approach while observing market trends is crucial. Successful navigation of today's landscape hinges on data outcomes and market responses.
Welcome back to Kitco News. Today, we've got a blockbuster of a discussion: the breakout potential of Tesla and the resilience of gold ETFs. Joining in is Anmol Singh, the founder of Live Traders, a recognized leader in trading education.
Absolutely. Anmol comes loaded with expertise on technical analysis, and with his firm ranked #1 for trading education, he carries a lot of weight in the market. Let's get straight to the facts.
So what's the main thesis from Anmol's insights? What should viewers be aware of?
Anmol emphasizes that while there are opportunities for growth in Tesla and commodities like gold, caution is crucial, given the current volatility and market uncertainties.
What about the current market conditions? Any vital indicators?
The Producer Price Index, or PPI, only rose by 0.1% in July, suggesting lower inflation. This signals to analysts that the Fed might consider rate cuts sooner than expected.
Now let's talk about Tesla. What are the technicals telling us?
Tesla's watched level is $235. If it exceeds this, we could see a rally up to the $300 mark, an exciting prospect for traders.
And what about gold? What forecast is on the horizon?
Gold, particularly through ETFs like GLD, has broken a 4-year consolidation pattern. It's set for a continued uptrend as global demand rises, especially with BRICS nations increasing their gold purchases.
What predictions did Anmol lay out for the next few months?
He foresees continued volatility in tech stocks and warns traders to exercise caution, especially if they're using leverage. Strategy is key.
And how about Tesla's long-term outlook?
If Tesla breaks those key levels, we're looking at a tremendous potential upside, though macro forces will still play a significant role.
To wrap things up, what are the key takeaways for viewers?
Anmol suggests that sectors like Tesla and gold are poised for potential growth, but stresses the importance of caution. Keep your eyes peeled for those critical levels and fluctuations ahead.
Welcome back to EPB Research. Today's big question: will we see a recession in 2024? We're diving into this hot topic with our economic experts, Brian McCarthy and Dayan.
Absolutely. Brian and Danny bring a wealth of knowledge and varying perspectives on the economy's health. Get ready for a thorough exploration.
What's the main takeaway from today's discussion?
The key thesis is that both speakers fear the U.S. economy may be inching closer to a recession as they observe signs of slowing in employment, financial conditions, and consumer spending.
Let's break down rising unemployment. What were the findings?
The unemployment rate has risen significantly, now at 4.3%. Notably, youth unemployment is the highest, a sign both speakers are monitoring closely.
And what about market volatility?
The recent wave of volatility suggests increased anxiety about economic conditions. Bad news is increasingly viewed as a negative indicator.
Any predictions regarding the Fed's actions?
Predictions suggest possible rate cuts as the Fed reacts to these economic signals. How they choose to respond could define economic stability.
What predictions can we expect about a potential recession?
Indicators suggest that rising unemployment and market unrest could point toward worsening conditions, possibly leading to recession.
Any forecasted actions from the Fed?
If economic conditions worsen, it's likely we'll see cuts to interest rates as an attempt to stabilize the economy.
Let's wrap up the main takeaways from today.
The discussions highlight the importance of monitoring indicators closely. It's clear that moving forward, a cautious and responsive approach from the Fed and market participants is critical.
Welcome to David Lin's channel. Dive in with us as we explore economic policies with the insightful Stephen Moore, a former economic advisor to President Donald Trump and a senior fellow at the Heritage Foundation.
Exactly. Stephen brings years of experience, having shaped significant tax policies under Trump and authored acclaimed books. Get ready for some valuable economic insights.
What key message does Stephen convey about today's economy?
His primary thesis revolves around rising prices, increased government spending, and the resultant pressure these factors put on everyday Americans. He argues inflation remains a significant issue.
Let's break down Stephen's key points, starting with rising prices. What's the situation there?
Biden's policies have led to a staggering 20% inflation. With wages only growing about 16%, most families are feeling the pinch with rising grocery and gas prices.
And what's the Fed's role in this mess?
Stephen believes the Fed should cut rates by a quarter or 50 basis points, but stresses that the root problems in the economy can't be solved solely by these actions.
Stephen's economic solutions seem radical. What are his ideas for addressing government spending?
He suggests downsizing the current budget, indicating that cutting spending can allow more resources to flow into the productive private sector.
What's happening with unemployment rates?
Surprisingly, government jobs and healthcare are booming, while critical sectors like manufacturing are underperforming. The balance is off, and it's causing concern.
What does Stephen predict long-term?
He foresees persistent inflation and an economy increasingly strained by extensive government spending if these issues aren't effectively addressed.
So, what are the closing thoughts from Stephen Moore?
He emphasizes the urgent need for focused reforms to rein in spending and tackle inflation. Only by making these changes can the economy recover and grow sustainably.
As we wrap up today's financial landscape, our experts reiterated key concerns surrounding inflation and capital flight.
While one highlighted caution in regards to rate cuts, another argued for proactive measures to stabilize markets.
However, they all agree on the importance of monitoring economic indicators closely for effective investment strategies. Thanks for watching Financial Insights in Minutes for August 14th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.